So we completed the old regime tax rates. Now we are jumping to the new regime. So new regime or default tax regime, tax rates for assessment year 26-27. The default tax regime tax rates are given under section 115 BAC. Section 115 BAC is applicable to both resident as well as non-resident. So for 115 BAC there is no resident non-resident concept. It is applicable to everyone. For whom and all it is applicable? Individual, HUF, AOP, other than cooperative society, BOI, body of individual, and artificial juridical person. Sir, why other than cooperative society? Because for cooperative society there is a different section, and for companies also there is a different section. For partnership firms alone there is no old regime new regime concept. Okay, wow. Partnership firms there is no old regime new regime. For local authority also there is no old regime new regime. Only for individual, HUF, AOP, BOI and AJP. Section 115 BAC tax rates are applicable on the total income which is chargeable to tax as per the normal tax rates. So normal tax rates which we had studied some while ago, that is up to 2,50,000 no tax, above 2,50,000 up to 5 lakh 5%, above 5 lakh up to 10 lakh 20%, above 10 lakh 30%. So for the same category of income, section 115 BAC was also applicable. And here the tax rates have changed from the previous year. Now what are the tax rates? Up to 4 lakhs no tax, above 4 lakh up to 8 lakhs 5%, above 8 lakh up to 12 lakh 10%, above 12 lakh up to 16 lakh 15%, above 16 lakh up to 20 lakh 20%, above 20 lakh up to 24 lakhs 25%, and above 24 lakhs 30% tax. So it means what? 4 lakhs the slab will increase. So 4, 8, 12, 16, 20, 24. Above 24, 30%. And by 5 you have to increase the tax. So 0, 5, 10, 15, 20, 25 and 30. So above 24 lakhs, 30% tax. Fine. So this is the tax rate under the new tax regime, that is section 115 BAC. In new tax regime, there is no special benefit which is given to resident senior and super senior citizen. Like in old tax, there is a benefit, no? For resident senior citizen up to 3 lakhs no tax. For resident super senior citizen up to 5 lakh no tax. But no such benefit in section 115 BAC. Also, if you see section 115 BAC, the tax rates are much lower compared to the old regime rates. Why are they much lower? Because in the old regime you get many benefits of deductions and exemptions, but in the new tax regime such benefits of deduction and exemption is not allowed to the assessee. What are all the benefits not allowed? It is given in the next page. We are not going to learn this now. As and when we are learning the respective heads of income, we will be covering all this. So these are the tax rates. Then coming to surcharge. Surcharge also above 50 lakhs up to 1 crore, 10% surcharge. Above 1 crore up to 2 crores, 15% surcharge. And above 2 crores, 25% surcharge. So there is no 37% concept in 115 BAC. New tax regime la 37% is not there. Only 25% is there. Then coming to section 87A rebate. Section 87A rebate. Here now let me also tell you the differences one by one. First let us discuss what are the provision, then difference with the old regime. So here rebate is allowed up to 60,000 for resident individual having total income chargeable to tax under 115 BAC up to 12 lakhs. Listen. Just a second. Slip the chair. Okay. So in old regime, what are the three conditions? Resident, individual, total income up to 5 lakhs. In new regime it is resident, individual, total income chargeable to tax under 115 BAC up to 12 lakhs. So total income up to 12 lakhs illa, it is total income chargeable to tax under 115 BAC is 12 lakhs. See, there is still confusion among people. Some faculty will tell you, some books will tell you total income up to 12 lakhs. Some books will tell you, including mine, that only total income under 115 BSc up to 12 lakhs. Personally speaking, this year it is very clear by the income tax department, by the central government, that the total income should consider only 115 BSc, not the other incomes. But still, when this type of confusion is prevailing, ICAI does not test it for CA Inter. So if at all you get a question in the examination, then total income will be up to 12 lakhs, including special income also. So you need not worry much about how we will attend in the examination. It will not be tested in the examination. But still, total income means total income chargeable to tax under 115 BAC up to 12 lakhs. So listen here. Let's say a person, Mr. A, is having normal income 10 lakhs and triple 1A income of 1 crore. Normal income 10 lakhs, triple 1A income 1 crore. So total income will become 110 lakhs. 110 lakhs. Now in this situation, is rebate applicable or not applicable? Answer is yes, rebate is applicable because the income which is taxable under 115 BAC is within the 12 lakhs mark. So for the 10 lakhs, whatever tax you calculate as per 115 BAC, for this you can claim the rebate. But for this 1 crore, whatever tax is applicable under triple 1A 20%, the entire tax has to be paid by the assessee. Purida. So on 1 crore, entire tax has to be paid. On this 10 lakhs, whatever tax is coming on this rebate can be claimed. So in this case, on this, since the income is more than 50 lakh rupees, surcharge also will be applicable. So in this case, on this 10 lakhs, you will enjoy rebate, and on the total income, whatever tax is coming, surcharge will be applicable at 15%. So same case, surcharge is applicable and rebate is also applicable. But in old scheme, it is not possible. In new scheme, it is possible. So rebate is allowed up to 60,000. In old scheme, how much? 12,500. New scheme, how much? 60,000. For resident individual, this part is the same. For resident individual only, rebate will be allowed. And maximum limit in old scheme is how much? 5 lakhs. That is total income. New scheme, only the income chargeable under 115 BAC, 12 lakhs. 12 lakhs. In old scheme, there is no marginal relief, but in new scheme, there is marginal relief. What is marginal relief? Additional tax should not be more than additional income. Additional tax should not be more than additional income. That is only marginal relief. So up to 12 lakh 75,000, if the income is there in the examination, marginal relief will be there. Above that, it will not be there. So rebate is, and rebate is only allowed against the normal rate income. That is 115 BAC income. It will not be allowed against triple 1A, 112, all the special rates. It will not be allowed. In old tax, only against 112A income, not allowed. But in new tax, for all the special tax rates, it is not allowed. Only for normal tax rate, it is allowed. Fine. So clear with the difference. We will also work out questions where you are going to find out rebate and marginal relief also. So you will be thorough. Then marginal relief, health and education says as usual 4% of income tax and surcharge. Here there is no change. Then in surcharge also marginal relief, same concept as old regime, there is no change. Section 288A also same, 288B also same. So total income you have to round off to the nearest multiple of 10. Then tax also you have to round off to the nearest multiple of 10. Alternate minimum tax we will study later on. So these are the tax rates for 115 BSc. Let us now calculate the tax quickly. So now quickly in your notebook, you find out income tax, total income under section 115 BAC is equal to 12 lakhs and total income is 12 lakh 15,000. 21 lakh. 12 lakhs and 12 lakh 15,000. This in 1 second itself you can tell the answer just by looking the question. 1 second itself you can tell the answer. For 12 lakhs, will there be any tax? No, because entire tax will be allowed as rebate. So entire tax will be allowed as rebate. But in what about 12 lakh 15,000? Here what will be the tax? Tax will be 15,000, because when the income is above, okay, you calculate the tax, you will yourself get the answer. Calculate the tax for both quickly. All those steps are no need to put. Quickly you just calculate the answer. So we can proceed. For 12 lakhs, the tax is coming as, first you got 60,000 only will come, no? So 60,000, then minus 87A rebate, correct? Before health and education cess. So minus 60,000. So tax will become 0. Tax will become 0, correct? Now for 12 lakh 50,000, here there is any confusion for 12 lakhs, okay? Up to 4 lakhs, 0. Above 4 lakhs up to 8 lakhs, 5%. Then above 8 lakhs up to 12 lakhs, 10%. So 20,000 plus 40,000, 60,000 is the total tax. Then entire amount will be allowed as rebate, hence the tax payable is 0. Now coming to the 12 lakh 15,000. So for 12 lakh 15,000, up to 4 lakhs it is 0. Then up to 8 lakhs it will be 20,000. Up to 12 lakhs 40,000, and up to 12 lakh 15,000 it will be 15,000 into 15%, which is 2250. 2250. So now what is the total tax? 62,250. Now how to calculate marginal relief, sir? Marginal relief is equal to, in case of rebate, very simple, actual tax minus total income above 12 lakhs. Actual tax minus total income above 12 lakhs. So what is the actual tax? Actual tax is 62,250. Then total income above 12 lakhs is equal to what? 15,000. So what is the difference? 47,250, yeah, 250. So 47,250. Just a second. Is marginal relief. 47,250 is marginal relief. So what is the tax? Tax is equal to 62,250, which is the actual tax, minus marginal relief 47,250. So tax comes to how much? 15,000. Tax comes to 15,000. So the total additional income, additional tax cannot be more than additional income. That is only the concept. 15,000 is only the additional income. So maximum additional tax can also be 15,000. Should I solve this properly? Present. Are you able to understand? Okay. Anyone? Please raise your hands if you are still having doubt. Should I re-explain? No? Fine. So total income, you are getting tax as 62,250. How much extra income you earned? 15,000 was the extra income. But how much is the extra tax? 62,250 is the extra tax. So extra tax is more than the extra income. Extra tax is more than extra income. In such case, marginal relief will apply. So extra tax and extra income will become same. So 15,000 will become the tax. Okay. Balance amount will become marginal relief. If the marginal relief is coming as negative, it means there is no marginal relief. Then after marginal relief, after this 15,000, you should not forget that you also have to calculate health and education cess at 4%. Then find out the final answer, round off to the nearest multiple of 10. Okay. So this is over. Now coming to special tax rates and special surcharge also we will learn. One time I want you all to say along with me the tax rates of 115 BAC. So up to 4 lakh rupees nil, above 4 lakh up to 8 lakh 5 percentage, above 8 lakhs up to 12 lakhs 10 percentage, above 12 lakhs up to 16 lakhs 15 percentage, above 16 lakhs up to 20 lakhs 20 percentage, above 20 lakhs up to 24 lakhs 25 percentage, and above 24 lakhs 30 percentage tax. Then surcharge total income above 50 lakhs up to 1 crore 10 percentage, above 1 crore up to 2 crores 15 percentage, above 2 crores 25 percentage. So no 5 crore slab for the new tax regime. Okay. Now let me quickly tell you about the old tax versus new tax when this opt-out scheme works and how it works. Let us discuss. So 115 BAC is the default tax regime. Karna. Listen, section 115 BAC is the default tax regime. It means what? If you don't choose anything, by default, you have to pay tax under 115 BAC. That is 4 lakh, 8 lakh, 10 lakh, 12 lakh, 12 lakh, 16 lakh slab that you have to pay the tax. Now, if you are comparing and seeing that whether old scheme and new scheme is beneficial, then you can also opt out to take the old scheme if you feel that old scheme is beneficial. Generally, you are in the new scheme only. That is the default tax regime. But if you feel that the old scheme is more beneficial, then you can also opt out and take the old scheme. But here there is a differentiation. You have to see whether the assessee is having PGBP income or no PGBP income. PGBP means what? Profit and gains of business or profession. Business and profession income. If business and profession income is not there, then very simple. You can opt out to the old regime, come back to the new regime year after year, any number of times you want, you can change. Okay. So this year I feel old scheme is beneficial, so I'll take old scheme. Next year I feel default regime is more beneficial, so I'll take default regime. Then again next year I will have the option to choose. There is no limit for the options. But if the assessee is having profit and gains of business or profession, then there is a problem. What is the problem? Default tax regime only should be followed by the assessee, but one time during the life, till he is having PGBP income, till the assessee is having PGBP income for so many years, only one time the assessee has the option to go to old regime. And only one time there is an option to come back to new regime. Now default regime is the regime. Default regime, how many years you want, you can continue in default regime, there is no problem. But in future, if you want to go to old regime, you can go only once. And if you want to come back, you can come only once. But if you go and come back, then you cannot go to old regime once again. So only one time option. Okay. So if you go in old, stay in old. But if you come back to new, then you can't go back to old once again. You got the point? Okay. That is only the option till you have PGBP income. So now I am having PGBP income. Let's say after 10 years, now I am no longer having any business or profession, just other sources. Then what will happen? Then I can choose old regime and new regime any number of years I want. Every time I can choose. Only when I am having business income or profession income, that time I have to take care of the option. Then now let's talk about employees. So when the employer-employee relationship is there, the employee will be receiving salary. When the employee is receiving salary, the employer will deduct TDS on the employee. While deducting the TDS, the employee has to tell which scheme he wants to go to. If the employee tells default tax regime, employer will deduct TDS in default tax regime. If employee is telling old tax, employer will deduct TDS in old tax. If employee does not tell anything, then what will employer do? Default tax regime. Fine. Now, if the employee asks the employer, please deduct my tax under default tax regime. Then, while filing the return of income, If the employee wants to change the regime, can the employee change? Answer is yes. While filing the return of income, even if the TDS was deducted under new tax regime, still employee can convert to old tax regime, no problem. And every year he can do this conversion. There is no issue unless the employee is also having PGBP income. Okay, if employee is having PGBP income also, then he has to be careful. So this was about old tax versus new tax, how to opt in, opt out. Now let us see alternate tax regime for other persons. So this is a part of your syllabus. Practical questions not going to come. Theoretically, maybe in multiple choice question can be asked. Okay, wow. So for domestic companies and cooperative society also, there is an alternate tax regime. Here also tax rates will be concessional rates, and deductions, exemptions, so many will not be allowed. Sir, what and all deductions and exemptions are not allowed, that you need not study. It is a part of final syllabus. If you know what is the concessional tax rate, that is enough. So 115 BAA and BAB is given to domestic companies. 115 BAA is for all the domestic companies, and 115 BAB is for manufacturing companies, the domestic companies engaged in manufacturing. For all the domestic companies, if they come into the new regime, that is 115 BAA, then their tax rate will be 22% plus 10% surcharge plus 4% health and education cess. So effectively it will become 25.168%. But if the domestic company is engaged in manufacturing, they can opt for 15% concessional rate plus 10% surcharge plus 4% health and education cess, effectively 17.16%. And you know what? In this new regime, even for income below 1 crore, surcharge will be there. So even if you earn 1000 rupees, surcharge will be there. Okay, wow. In the new tax regime for companies, I am telling. Right? Only for companies and cooperative society in the new tax regime, there is no limit for surcharge. From 0 rupees itself, from the initial income itself, surcharge will start. Then 115 BAD, 115 BAE for cooperative society. What about 115 BAC? That is individual, which we have studied. So BAD and BAE is for cooperative society, resident cooperative society. So if they are not engaged in manufacturing, 22% plus 10% surcharge plus 4% health and education cess. Then new manufacturing cooperative society means 15% tax plus 10% surcharge plus 4%. So effectively it is 17.16. So same concept for domestic company also, resident cooperative society also. Here resident is there, domestic is there. But for individual, HUF, AOP, BOI, AJP, no resident in non-resident concept. Here you will be very, very clear. Exam hall lada, all these questions will arise when you are answering. Non-resident, for non-resident is 115 BSc applicable. You should not think. For resident as well as non-resident, the new scheme is applicable. Fine. Now, special tax rates. Let us see the special tax rates also one by one. See, these special tax rates we are going to learn in that chapter, but still let us know what are the rates, so that whenever we are solving the questions, it will be easier for us to solve. We will be familiar. And you have to memorize all these rates. So one time itself, in one shot, if you memorize, well and good. Basic concepts we have already studied. Section 115 BBE for undisclosed source of income. What is the tax rate? 60% tax plus 25% surcharge plus 4% health and education cess. Then in PGBP we are going to learn AMT. Now we will be learning in deduction chapter, not in PGBP, deduction chapter. So alternate minimum tax is 18.5%. 18.5%. Now for your syllabus, cooperative society IFSC is not there, so no problem. Then capital gains. In capital gains, we are going to study section 111A, which is short-term capital gain on equity shares, unit of equity-oriented fund, and unit of business trust. So 111A, what is the tax rate? 20% tax. 20% tax. Then in capital gains, long-term capital gain, there are two special tax rates. So general long-term capital gain is 112. Special long-term capital gain is 112A. Okay, so 112A, what is the tax rate? Long-term capital gain on equity shares of company, unit of equity oriented fund, and unit of business trust. What is the tax rate? Up to 1,25,000 nil. Up to 1,25,000 it is 0. Please write above 1,25,000, it is 12.5 percentage. Like this, if you study, it will be better, easier for you to understand. So here also there is a slab rate system under 112A. Up to 125, zero tax. Above 125, 12.5 percentage. Since this 1,25,000 benefit is there, no, that is why only the old regime does not give the benefit of rebate for this income. Then general long-term capital gain. What is the tax rate? It is 12.5 percentage without indexation. 12.5 percentage without indexation. However, there is a benefit which is given to individual and HUF. If a person is individual or HUF and they have a land or building or both which is purchased before 23/7/2024 and sold on or after 23/7/2024, and if it is a long-term capital asset, then they are having the option to choose 12.5 without indexation or 20 with indexation. 12.5 without or 20 with indexation. Listen, before 23/7/2024, what was the tax rate? You know, the tax rate itself was 20% with indexation. From 23/7/2024 onwards only, whatever long-term capital gain is there, on that the tax rate has been decreased to 12.5%, but no indexation benefit will be given. Okay, sir, our previous year itself is 25/26. So for during 25/26, whatever transfer is happening, on this we have to learn this tax rate only, correct? 12.5% without indexation. Old rate, should we study or not study? Answer is, in long-term capital gain, you have to study the old rate also, because in questions the institute is giving last year's transfer and asking you to calculate the tax. So you have to study old rate also, new rate also. Now I am just brushing up while taking long-term capital gain. Once again we are going to study in detail, so don't worry. This I have given here just so that it is easier for you to by heart all the rates. Then income from other sources. Section 115BB is there for winning from lottery, crossword puzzle, horse race, card games, gambling, betting. For that, tax rate is how much? 30%. And for online games also, tax rate is 30%. Then alternate minimum tax is 18.5. This I have given 2 times. Huh? Here also it is given, here also it is given. Here I forgot to remove. Then this is not that important, foreign company. Okay. Now let us see surcharge in case of special income. Listen here. So when the government introduced 25% and 37% surcharge, earlier 25-37 was not there. One day only government introduced 25 and 37%. When they introduced 25 and 37% surcharge, the foreign investors got very upset that we have to pay so much tax for investing in India. That is why they started taking out their money and started withdrawing their money from India. So to stop this only, the finance minister came and announced that on certain category of income, the surcharge will be only 15. Maximum how much? 15. Above that we are not going to charge. What are those incomes? Those incomes are dividend income, 111A income, 112 income and 112A income. Okay. So 112 long-term capital gain, 112A long-term capital gain special case, 111A short-term capital gain special case, and dividend income. Basically they are covering all the shares. See, equity shares are there, no, which are traded on stock exchange. It is covered in 111A and 112A. Moreover, these shares give dividend, so dividend is also covered, and now they have also covered long-term capital gain. So these 4 types of income, maximum surcharge can be how much? 15%. 15%. Above that it cannot go. So now how to study surcharge? How to calculate surcharge? Whenever you are finding a question, you have to see whether the total income is more than 2 crores or not. Okay. If total income is not more than 2 crores, then why to worry? However, maximum 15 only, you can easily calculate and solve the answer. If the total income is more than 2 crores only, you have to see whether the income is having special income or not. So if the income is greater than 2 crores, then the divide the income into two parts. Okay, special income other than special income. What are the special income in this case? Dividend 111A, 112, 112A. Okay, so on dividend 111A, 112, 112A, always maximum surcharge will be how much? 15 percentage, 15 percentage. Now you see what is the other income. If other than 111A, 112, 112A and dividend is up to 2 crores, then 15 percentage, more than 2 crores, 25, more than 5 crores, 37. Purida, you see this one in old regime. This will be more easier to understand. So first what you have to see, step 1, total income should be greater than 2 crores. If total income is greater than 2 crores, divide income into two parts. Okay. First part is what? Dividend 111A, 112, 112A income. On this, always the surcharge is going to be 15. For others, other income, if it is up to 2 crores, 15, more than 2 crores up to 5 crores, 25, more than 5 crores, 37 percentage. Purida, more than 5 crores, 37 percentage. Now this question is there. I want you to solve this question by yourself first, then we will discuss the answer. You need to see presentation and all. Just if you are able to get the answer, that is enough. On the first three incomes, maximum limit is 15% on surcharge. In the last income only it is, however the table tells you. You have to calculate. Calculate as per optional tax regime पर ना, old tax. I tell you where you will find a problem. In surcharge of dividend only you are going to find a problem. So according to you, how you should solve, you solve. Then we will discuss the answer. Today, do you have any tests in the evening? Tomorrow? Done? Okay, shall we solve quickly? Calculate the tax payable for assessment year 26-27. So tax payable. First, let us calculate the rates one by one. So total income consists of 112A income. So LTCG under section 112A. What is the income? 3 lakhs. 3 lakhs, no? So up to 1,25,000 nil up to 3 lakhs, it will be 1,75,000. into 12.5 percentage, which is 21,875. And write 21,875. Then second one is what? STCG triple 5 lakhs. STCG under section 111A is 5 lakhs multiplied by 20 percentage, which is 1 lakh. Directly we can write in outer column. Okay. Then third one, dividend 15 lakhs, other income 3 crores. Now 15 lakh and 3 crores both are taxed at normal tax rate. Three crore 15 lakhs. Here up to 2,50,000 is nil. Up to 5 lakhs it is 2.5 lakhs into 5%, 12,500. Then up to 10 lakhs it is 5 lakhs multiplied by 20%, so 1 lakh. Then up to 3 crore 15 lakhs it is 305, 1 2 3 4 5 into 30%, 91 lakh 50,000, 91 lakh 50,000. So total plus 92 62 500, correct? 92 62 500. So what is the total tax? Plus 1 lakh plus 21875, 9384375, 9384375. So this we have got. Now we are going to find out surcharge. Surcharge. So surcharge on LTCG under section 112A is equal to 21875. 21875. Surcharge is the percentage of tax. So 21875 into 15%. Now listen. First let me tell you about the table. Here what is the total income? The total income comes to 3.23 crores. 3 crore 23 lakhs. Okay. Now 3 crore 23 lakhs, you have to look at this table. Where does 3 crore 23 lakh comes? Here. Where the income other than dividend 111A, 112, 112A is greater than 2 crores but up to 5 crores because it is 3 crores. Okay, wow. 3 crores. So normal income 25% surcharge, dividend 112, 111A, 112A 15% surcharge. So all on these three types of income, special income 15% is the surcharge, and on other income 25% will be surcharge. 25% will be surcharge. So that is why I calculated 15%. 15. Okay, wow. So what is the answer? 381. Then STCG under section 111A is equal to 1 lakh, 1 lakh into 15%, 15,000. Then dividend income. Now for dividend, you don't know what is the tax on dividend. So first you have to find out what is the tax on dividend. How to find out, sir? Using proportionate method. Proportionate which find out panikla. Okay, wow. So first you find dividend tax. Tax on dividend How to find out? See, this 9262500 is the tax on dividend plus other income. So what will be the tax on dividend? We have to find out. So what we will do, 9262500 divided by 3 crore 15 lakhs, 3 crore 15 into what is the dividend? 15 lakhs. 15 lakhs. So we did simple proportionate formula to find out what is the dividend tax. We know what is other income plus dividend combined tax. Now we have to find out dividend tax. So we do the proportionate calculation. So total divided by total multiplied by dividend is equal to dividend tax. How much? Huh? 071. Okay. This is tax on dividend. Now you can put surcharge on dividend. On dividend is equal to 441071 multiplied by 15 percentage. 66161. Okay. Now other income. Tax on other income is equal to, first you find the total, reduce the dividend tax, you will get other income tax. Okay. So total is how much? 9262500 minus 441071. If you reduce it, 8821429. 8821429. Now we will find out the surcharge. Surcharge is equal to 8821429 into how much percentage? 25 percentage. 25 percentage, because other income is more than 3 crores. Up to 2 crores 15, above 2 crores 25, above 5 crores 37. So 2205357. 2205357. Now you have to add all of this together. One one 674,174. Am I correct? Like wrong? Correct. Now you have to add cess. This you should not forget. Add health and education cess at 4 percentage. 466,967. And tax payable will be 121,411,40. Rounded off. This is difficult level of question. 99% this will not come in the examination. Easier than this only will be asked. But if you know this, then any question in exam you will be able to solve. Generally they will not mix dividend and other income and give. They will give separately only. So for 111A, 112, 112A and dividend, for these 4 types of income, maximum surcharge is 15%. Hence, if the total income is greater than 2 crores, divide the income into two parts. First part is what? Dividend 111A, 112, 112A income. Second part is other income. So on the first part, always provide 15%. On the second part, up to 2 crores 15, above 2 crores 25, above 5 crores 37. The same concept will also apply to new regime. Okay, but in new regime 37% is not there. Okay, so up to 25 you have to stop. So if you see this table, you will be able to understand. In new regime also, what you have to do, see if the total income is greater than 2 crores. If it is greater than 2 crores, then for income other than dividend 111A, 112A, if it is up to 2 crores 15%, then above 2 crores 25%. On dividend 111A, 112, 112A, always it will be 15 only. 15 only. Fine. Clear with this surcharge? Shall we move on to next? So with this, tax rates is over. Whatever questions are given in your top 100 that I have given you, so that you can solve at your end. Few questions we have already solved, remaining you yourself will be able to solve. If you have any doubt, you can ask me. Then residential status. Now let us come to residential status. Small chapter, but very, very important chapter. Definitely going to be tested in your examination. Residential status. And we will learn in such a way that you will not make mistake in exam. So now we have completed the basic concepts. We have completed tax rates, normal tax rate as well as special tax rate. Now we are jumping on to residential status. We have to find out whether a person is a resident or non-resident, because for a resident, entire global income is taxable. For non-resident, only Indian income is taxable. That is why we are studying residential status. Firstly, let us quickly cover definition of India. Not important from practical point of view, theoretically may be asked. So one time if you have a glance, that is enough. India means territory of India as per Article 1 of the Constitution. So all the states and all the union territories, including Jammu and Kashmir and Ladakh also. The territorial waters, seabed, subsoil, underlying such waters. So territorial water, all the rivers, seas, okay, then the seabed below the water, subsoil below the water is also covered in India. Continental shelf is also covered in India. Exclusive economic zone is also covered in India. Exclusive economic zone means from the coast 200 nautical miles. If you know also, not a problem. If you don't know also, not a problem. Any other maritime, specified maritime zone which is specified, and airspace above the territory and territorial waters. This is a part of India. So what is India? Territory as per Article 1 of the Constitution, territorial waters, seabed, subsoil, continental shelf, exclusive economic zone, any other specified maritime zone, and airspace above the territory and territorial waters. This is only India. Then now let us see how to determine residential status. Most important is the residential status of individual. You should know how to determine. So how to determine residential status of individual? To know whether the individual is a resident or non-resident, you have to check for section 6. Section 6. In section 6, section 6 subsection 1 gives two basic conditions. If any one of the basic conditions are satisfied, the individual will be said to be a resident. Individual will be a resident. What are the basic conditions? Number 1, stay in India is 182 days or more in the previous year, during the previous year. So if stay is more than 182 days or more, the individual will be a resident. And this condition is always there. There is no doubt at all. For second condition only you will get exceptions and all. But for the first condition, there is no exception, no nothing. So stay in India for 182 days means resident. Very, very simple. There is no if and but in that. Now, second basic condition. Second basic condition is that if the individual stays in India for 60 days or more during the previous year and 365 days or more in the 4 preceding previous years, then the individual will be resident. So, in the second basic condition, it is a cumulative condition. Cumulative means what? Two conditions are there. Both should be satisfied. Then only this condition is said to be satisfied. What are the two conditions? Stay in India should be 60 days or more during the previous year and 365 days or more in the 4 preceding previous years. If both are satisfied, then this condition is satisfied. If this condition is satisfied, the individual will be resident in India. However, for the second basic condition, there are certain exceptions. Certain exceptions. Exceptions means what? If a person is covered in any one of the exceptions, then for such a person, you need not see the second basic condition. You just see first basic condition, that is enough. Okay, so for these persons, what did I say? If first basic condition is satisfied, they are resident. First basic condition not satisfied, they are non-resident. Second one paaka venda, no need to see the second one. For the exception cases, what are the exception cases? Number 1, Indian citizen leaves India as a crew member of an Indian ship. Indian citizen leaving India, going out of India as a crew member of Indian ship. Second point, Indian citizen leaves India for the purpose of employment outside India, going for employment outside India. Then third one, Indian citizen or person of Indian origin visiting India. So first two conditions la enna paathom? Going out of India, going out of India. Third condition is coming into India. Indian citizen or person of Indian origin. What is person of Indian origin? Person of Indian origin means any person who himself or either of their parents or either of their grandparents were born in undivided India. Undivided India. Undivided India means what? India before partition in 1947. Before partition in 1947. Let's say all my grandparents, I'm in Indian, all my grandparents, okay, maternal side also, paternal side also, were born in India only, but they were born after 15 of August 1947. After 15 August 1947. All my grandparents, mother side also, father side also, all of them were born after 15 August 1947. They were born in India only. Will I be considered as person of Indian origin? Yes or no? Answer is no. Because they should be born in undivided India. புரியுதா உங்களுக்கு? Divided India illa, undivided India. Then only PIO concept will apply. So if I am born in India, I am not born in undivided India. So for me, condition not satisfied. My parents also not born in undivided India, not satisfied. Grandparents also not born in undivided India, so condition not satisfied. So hence I am not person of Indian origin. Okay, but I am Indian citizen. That is different. So Purida, person of Indian origin means person who himself or either of his parents or either of grandparents were born in undivided India, that is India before partition in 1947. So PIO, Indian citizen or person of Indian origin visiting India during the previous year and his total income other than income from foreign source is up to 15 lakh rupees in the previous year. Other than income from foreign source. What is other than income from foreign source? We are going to study in some time. But if other than income from foreign source is up to 15 lakhs, then also they are covered in exception. But if other than income from foreign source is more than 15 lakhs, then they are not covered under full exception. They will be covered under partial exception. Partial exception. Partial exception means what? Instead of 60, you take it as 120 as the condition. 120 as the condition. Let me explain you the help of a game. You know Mario, correct? You know Mario, right? Now let's imagine that Mario, you are playing Mario game. You're playing Mario game. And here only there is the castle. And here only there is the princess. Okay. So princess is waiting for Mario. You know who is this princess? This princess is non-resident. This princess is non-resident. If you win the game, you become non-resident, because all people want to become non-resident only. Why you want to become non-resident? If you are a non-resident, you only have to pay tax on Indian income. You need not pay tax on foreign income. That is why every person wants to become non-resident. Non-resident. So now in this Mario game, first is the 182 days condition. 182 days condition. If you satisfy the condition, Damal, you will hit this wall and you will fall down. Okay, you will hit this wall and fall down. Where you will fall down? In dungeon. Okay, and in dungeon also there are two dungeons, that is ROR dungeon and RNOR dungeon. ROR dungeon means more punishment. RNOR means less punishment. Fine. So you will fall down into dungeon. If you dash the wall, 182 days condition you satisfy means what? You have hit the wall and you fall down into the dungeon. But if you do not satisfy the condition, you can jump and go to the next stage. In next stage, you are having a tunnel. Next stage, you are having a tunnel. When can you go inside the tunnel? You can go inside the tunnel if you satisfy one of the three conditions. What are the three conditions? Indian citizen who is a crew member of Indian ship leaving India. Indian citizen who is leaving India for employment outside India. And third one, Indian citizen or person of Indian origin visiting India during the previous year, whose income other than foreign source is up to 15 lakhs. Up to 15 lakhs. If you are covered in these three, you can go inside and directly come out. You need not even see this wall. The second basic condition you need not see. What is the second basic condition? 60 days plus 365 days. 365 days. 60 days plus 365 days. Now listen. If at all you are not able to go inside the tunnel, it means you are not covered in three exception. You are not able to go inside the tunnel. Then what? Then you will see the second basic condition. Second basic condition also, if you are hit, okay, then what will happen? You will fall inside the dungeon. But if second basic condition you do not satisfy, you can jump and go to the next stage. Jump and go to the next stage. Here listen to me. Here what happens is, if at all there is a Indian citizen or person of Indian origin who is coming into India, who is visiting India, and income other than foreign source is greater than 15 lakhs. Less than 15 lakhs means they will go into tunnel. If it is greater than 15 lakhs, then you know what will happen? This wall will become a smaller wall. It will become a smaller wall of 120 plus 365. Means what? They can easily jump. 60, 365 means they will dash and go inside. 120 and 365 means the wall will become smaller. They can jump and go to the next side. Purida? Now when they come here to this stage, then this is the last stage. This last stage is called deemed resident. Deemed resident. In deemed resident, we are going to see some condition. If that condition is satisfied, you again dash on the wall and you go inside the dungeon. But if this condition also you do not satisfy, you can finally go to the castle and meet your princess non-resident. Okay, wow. Now in dungeon, when you go inside the dungeon, there are four gates to go to RNOR category. If you are in ROR category, more punishment. It means what? On the entire world's income, you have to pay the tax. But in RNOR category, on pure foreign income, you need not pay the tax. Pure foreign income, you need not pay the tax. So there are four doors. If any of the four doors you are able to open and go inside, you will escape. But if all the four doors are not opening, you have to stay in ROR. What are the four doors? Door number one is that you are non-resident in 9 out of 10 preceding previous years. So NR in 9 out of 10 preceding previous years. Then second door is stay in India 729 days or less in 7 preceding previous years. 729 days or less is the second door. Third door is the category who were jumping on this wall, small wall, shorter wall, 120 plus 365, but they were not able to jump. It means what? The stay in India is less than 182 but more than 120 for the person of Indian origin or Indian citizen who is having an income of other than foreign source more than 15 lakhs. Purida, you are having this, you are not able to jump from the short wall also, so directly you will fall into RNOR category, resident but not ordinarily resident. So income from foreign source, income other than foreign source greater than 15 lakhs, greater than 15 lakhs is third door, and fourth and final door is deemed resident. Deemed resident. So there are 4 doors. So one more time let me tell you. After this easily you will be able to, please try to visualize. So you are playing the game, Mario game. First wall you see is 182 days wall. If you see the wall, if you are hit by the wall, directly you fall into dungeon. Fine. Then you jump over the wall. If you are not satisfying the condition, you jump and you go to the next stage. Next stage, what you have to see? Tunnel. In tunnel, 3 type of people can go. Who can go? Number 1, a crew member, Indian citizen crew member leaving India. Okay, leaving India. Second is Indian citizen who is leaving India for employment outside India. Third one is Indian citizen or person of Indian origin visiting India and whose income other than foreign source is up to 15 lakhs. So they can go inside this. They need not see 63-65 condition at all. Directly they can go and check whether deemed resident is satisfied or not. Okay, but if they are not able to go inside tunnel, then first you have to see whether the person is Indian resident, Indian citizen or person of Indian origin who is visiting India, whose income other than foreign source is more than 15 lakhs. If it is more than 15 lakhs, then what will happen? This wall will become a smaller wall that will state only 120 plus 365 condition. 120 plus 365 condition. No need to see 60 plus 365. You should see what? 120 plus 365 condition. Here also, if it is more than 120 days stay, then you will hit the wall and go inside dungeon. But directly you will go inside RNOR. Directly RNOR. Just a second. Directly RNOR. Resident but not ordinarily resident. Similarly, next deemed resident. Deemed resident, if you are able to, if you satisfy the condition, directly you will go in RNOR category. If you are not satisfying this also, then only you will be considered as non-resident. Purida. Now let us see the provisions you will be able to visualize. First basic condition, individuals should stay in India for 182 days or more during the previous year. Second one, person should stay in India for 60 days or more during the previous year and 365 days or more during the 4 preceding previous years. If any one of the 2 conditions are satisfied, the individual will be called resident. However, for second basic condition, there are 4 exceptions. 3 full exception, 1 partial exception. What are the full exception? Number 1, if there is an Indian citizen who leaves India as a crew member of Indian ship. Second one, Indian citizen leaves India for employment outside India. Third one, Indian citizen or person of Indian origin visiting India during the previous year and total income other than foreign source is up to 15 lakhs. 15 lakhs. And partial exception, if it is more than 15 lakhs, then instead of 60, you consider 120 days and solve the question. Instead of 60, consider 120 and solve the question. However, this category of people are there, no? Indian citizen, person of Indian origin who are visiting India and their total income is more than 15 lakhs. If their stay is between 120 and 182, okay, 182 cross panniyachu sir, but 120 nala maatitom. In such case, you will be always called as RNOR. RNOR benefit you will get. Okay. Then deemed resident. What are the conditions to satisfy that the individual become deemed resident? First, notwithstanding anything contained in 6.1, if all the conditions are satisfied, individual shall be deemed resident. What are the conditions? Number 1, person is Indian citizen. Number 2, having total income other than foreign source more than 15 lakhs. Number 3, not liable to tax in any other country. Okay. And number 4, not a resident as per 6.1. Not a resident as per 6.1. So if these 4 conditions are satisfied, individual will be called deemed as resident. In a condition, he should be Indian citizen. Other than foreign source income should be more than 15 lakhs. Then third one, he is not liable to tax in any other country, and he is not a resident as per the before provision. Then he will be called a deemed resident. Deemed resident is always RNOR. Deemed resident always RNOR. Fine. Now, section 6 subsection 6 gives additional conditions to be RNOR. If any one of the conditions, so 4 doors are there, no, any one door if it opens, then the person can escape and go into RNOR category. What are the 4 doors? Number 1, non-resident in 9 out of 10 preceding previous years. Number 2, stay in India should be 729 days or less in the 7 preceding previous years. Number 3, Indian citizen or person of Indian origin visiting India during the previous year, total income other than foreign sources more than 15 lakhs, who stay in India is 120 days or more but less than 182 days. So they come in RNOR category. And lastly, deemed resident also comes in RNOR category. If all these 4 conditions are not satisfied, then sad, the person will be called as ROR. Okay, resident and ordinarily resident. Are you able to visualize? Okay, we'll solve a question also. That time you test this, it will be very easy for you to find out the answer. Here I see that students are generally making silly mistakes in the examination while finding the residential status. So in the type of visualization, first I used to give them step by step method. That is a headache. So if we visualize like this, it will be easier for us to find out the answer. Now, okay, first let us solve a question. Then we will continue with remaining provisions. Unga DT top 100, this book is there, no? In this residential status, first question you solve. Be quick. If you solve the answer, that is enough. Then we'll have a discussion. All of you are having the book in hand. I'll just keep this. He a student, no? So Mario also will be a little complicated only. Then okay, let's see. Bretley, an Australian cricket player. So Australian cricket player means what? Australian citizen. Australian citizen visits India for 100 days in every financial year. This has been his practice for the past 10 financial years. Find out his residential status for the assessment year 26-27. Would your answer change if the above facts relate to Srinath, an Indian citizen who resides in Australia and represents the Australian cricket team? Then again, would your answer, what would be the answer if Srinath has visited for 120 days instead of 100 days every year? So let us see. First one, for how many days the person has been staying? 100 days, correct? So previous year 26, sorry, 25, 26. 25, 26. So 25, 24, 23, 22, 21, 20, 19, 18, 17. So 100 each. Bretley is staying for 100 days each in the last 10 years. Fine. Now, we have to find out what is the residential status. So first, to find the answer, what you will do, first block, that is 182 days. Whether condition is satisfied or not satisfied, we have to see. During the year, 182 days condition not satisfied. Hence, the person will successfully go to the next stage. Next stage, you have to see whether he can go into the tunnel or not. Whether he can go into the tunnel or not. Answer is no, he is not able to go into the tunnel because he is neither Indian citizen nor is he person of Indian origin. So he cannot go into the tunnel. Then there is a second condition, which is 60 plus 365. Is he satisfying 60 plus 365? Answer is yes, he is satisfying. So he dashes here, then he goes into the dungeon. So ROR, RNOR. Now you have to see whether the person is, so he is resident. Now it is decided that the person is resident. Whether resident is ROR or RNOR, we have to decide. So to decide, there are 4 doors. If any of the 4 doors open, that is enough for him to become RNOR. First door is what? Non-resident in 9 out of 10 preceding previous years. Second one is 729 days or less in the 7 preceding previous years. Now, the second condition is easier to calculate than the first condition, correct? So, in the examination also, it is not necessary that you calculate the first condition first, second condition second. Whatever you can calculate easily, first you go for that. Because if you can calculate something easily and then get the answer then itself, then why bother to go for the next condition? Purida, that is why let first condition difficult to calculate, second condition very easy to calculate because 100 day per year. So in the last 7 years, if you see, he is staying for how much? Only 700 days. 700 days, which is 729 days or less. 729 days or less. That is why he can open the door. Only one door opens, it is enough. He can open the door and go to the next. So he will be called as RNOR. Okay, answer solved. Now let's come to the next category. It is about Srinath. If it is about Srinath, then what to do? Then what to do? First one, the 182 days. Same question, but instead of what Bretley, now Srinath has come. Srinath is an Indian citizen. So only one change, that Indian citizen is there. So 182 days condition, is he able to cross? Answer is yes. He is not satisfying, so he has crossed the 182 days condition. Now let us see the tunnel. Is he able to travel the tunnel or not? Here only there is a confusion or not clarity. The clarity is not there in the question. Why clarity is not there? Because he is an Indian citizen that you know, but you do not know, and he is visiting India. So every year he is coming to India. So Indian citizen visiting India, but what is his income other than foreign source? That you do not know. If his income is other than foreign source is up to 15 lakhs, then he can travel the tunnel and go on the other side. And in Australia, they usually charge income tax. That is why he can cross deemed resident also, and he is non-resident. Purida, Australia charges income tax. If the country where they reside, if they are charging income tax, then you need not see the deemed resident condition. Only where you are living, if there is no income tax, then only deemed resident condition will be satisfied. So you can cross and you can become non-resident. If it is up to 15 lakhs, if it is more than 15 lakhs, then what will happen? Then this wall will become a shorter wall called 120 plus 365. Then also he will be able to jump the wall because he is staying for 100 only. So 120 he will not dash. Then also he will be able to jump the wall. Then also he will become non-resident. Okay, va? So both cases Srinath is going to become non-resident. Are you clear? Okay, tunnel la ponalu he will cross and become non-resident. If this become 120 also he will become non-resident because he does not satisfy 120 plus 365 condition. It is only 100 days. 120 days he is not staying. Now let us see the next question. Next question la what happening? What is happening? They are staying for 120 days in every single year. 120 days in every single year. When they are staying for 120 days in every single year, 182 days condition, is it satisfied? Answer is no. So they will jump and go to the next stage. Then there is another called 60 plus 365, correct? Another wall. Now you have to see whether they can cross the tunnel or not. Now here only comes the problem. If at all their income other than foreign source is less than 15 lakhs, they will cross the tunnel, and that deemed resident also they will cross, they will become non-resident. What if income other than foreign source is less than 15 lakhs? Then they will become non-resident, correct? Non-resident, because they will go inside the tunnel, they will come out of the other side. 360 365 paaka venda, and next stage la they only have to see the deemed resident condition. That also they do not satisfy, because in deemed resident to satisfy the condition your income should be more than 15 lakhs. So that also they do not satisfy, so they become non-resident. So if Srinath's income other than foreign source is within 15 lakhs, he will become non-resident. But if Srinath's income other than foreign source is more than 15 lakhs, then what will happen? Then here the wall will become 120 plus 365. Even though it became 120 plus 365, still he will dash this wall. Then he will fall into the dungeon, and directly he will fall into RNOR category. RNOR category. Why RNOR category? Because we have seen that one of the doors to RNOR is what? Indian citizen or person of Indian origin visiting India whose income other than foreign source is more than 15 lakhs, whose stay in India is 120 days or more but less than 182 days. They will be called as RNOR. So fourth case la they will be called RNOR. Okay, wa? So able to visualize. So whenever you are solving the question, you visualize like this, find out the answer in your mind. Then after finding out the answer, then you write the provisions. It is not enough if you just write the answer. For the answer, it will carry only 1 or 2 marks in the examination maximum. The majority of the marks are awarded only for the provisions. Okay, wa? So you have to see whatever provisions are hit in this question. So in the question la all the provisions are hit. All the provisions are hit. What are the provision? Basic condition also getting deemed resident mottu idla varala, correct? So deemed resident alone you should not write in the exam. All the remaining provision you have to write in the exam. What are the basic conditions? What are the additional condition? What are the condition to become RNOR? What are the exceptions? Everything you have to write. Then you have to write the analysis. Then you have to write the conclusion. Just for writing the answer, you will not get the marks. So how you have to write? If you get a question like this, then first you have to write the provision as per the Income Tax Act, as per the provisions of the Income Tax Act. If any one of the following basic conditions are satisfied, the individual will be a resident. Number 1, stay in India should be 182 days or more. Number 2, stay in India should be 365 days or more in the previous year and 365 days or more in the 4 preceding previous years. 365. Then you have to write below that. However, in the following cases, the second basic condition need not be seen. So first, number 1, ada Indian citizen, crew member of Indian ship going outside India. Then second one, the Indian citizen leaving for employment outside India. Third one, Indian citizen person of Indian origin whose income other than foreign source is up to 15 lakhs visiting India. And then below that you have to write, however, if a person is an Indian citizen or person of Indian origin whose income other than foreign source is more than 15 lakhs is visiting India, instead of 60 days, we will convert it into 120 days and then solve the question. That you have to write. Then you also have to write the provisions for RNOR. If a person is a resident, the following, if only one of the following conditions are satisfied, the person will be called a resident but not ordinarily resident. All the 4 you have to state. Then only you have to write. In this question, Bradley has stayed in India for n number of days and then write the answer. So provision is a must. Provision kada marks. Okay, for answer, less than half of the marks are for the answer and calculation. Majority of the marks are given for provision only. Definitely you have to write. So if you do diagram or whatever interpretation like this in your mind, if you do the calculation or in rough work you can do whatever this calculation is there. First, you will find out the answer also easily, and you will also know what are all the different provisions that are triggered. That provision you quote in the answer. Residential status. Fine. So this one is done. Now let us continue. Residential status. Okay. Some small points, important points, and then we will see crew member provision. Residential status, majority is this individual only. Idukapro easily, quickly we will be completing. Today 4:30 we will be winding up the class, 45 minutes. So bear with me, another 45 minutes. Then we can complete residential status. Now listen here. Concept of any doubts in individual residential status? Any doubts? Are you clear, Tarao? Fine. Let us continue. Concept of resident and citizen are different. In income tax, citizen can be resident, citizen can be non-resident, non-resident can be citizen. Okay, or non-citizen can be resident. Listen, come back. So citizen and resident concept is completely different, not linked with one another. Then residential status has to be determined every year. So in this year, if I am resident, next year I might not be resident. Every year I have to keep on calculating. Next, listen, very important. date of arrival, date of departure, both are calculated in India. Okay, so the day on which you leave, that day is also considered in India. The day on which you come to India, that day also is considered as in India only. So date of departure also in India, date of arrival also in India. Both are considered in India. Then continuous stay is not compulsory. So this 182 days we calculate, no, it need not be continuous. It can be in bits and pieces also. For example, first they are staying for 4 months, then going back to foreign country, then coming back, then staying for 3 months. So total 7 months acha resident. Next. Stay in India includes stay in territorial water also. Then individual can be resident in more than one country also. So I can be resident in India also, I can be resident in US also. Then what to do? I'll pay 100% tax in India and 100% tax in US. Answer is no, it does not work like that. So if I'm resident in India also, I'm resident in US also. In such case, India and US will have an agreement with each other who is going to tax that person. It is called double taxation avoidance agreement. It is in the CA final syllabus. Then person of Indian origin we have seen. Then income from foreign source that we are going to see now. Okay. This is over. Now let us see special provision for Indian citizen crew member of Indian ship. Indian citizen crew member of Indian ship. If all of the following conditions are satisfied, then the period from the date of joining in CDC to the date of signing off in CDC will be treated as outside India. Outside India. What are the conditions? Number 1, Indian citizen. Number 2, crew member. Number 3, foreign bound Indian ship. Number 4, on an eligible voyage. Now listen to me. Listen to me. Very, very simple. So there is a ship, Kanna. There is a ship. This ship is an Indian ship. Indian ship. However, it is foreign bound. Foreign bound. Foreign bound means what? It goes to foreign country, comes back from foreign country. And this foreign bound ship is on an eligible voyage. Eligible voyage means what? Either coming from foreign country to India or going from India to foreign country. That is only eligible voyage. And in this Indian ship, there is a Indian citizen crew member. Indian citizen crew member. So Indian citizen crew member on a foreign bound Indian ship in an eligible voyage. If all these conditions are satisfied, then you have to see CDC. Continuous discharge certificate. This is nothing but a attendance register only for the ship. So if you are entering into the ship, you will sign and go inside. When you are coming out of the ship, you will sign and come outside. Simple. Now this continuous discharge certificate, when you are signing, it will be considered outside India. From the date of signing in till the date of signing off will be considered as outside India. Outside India. So this is a exception. Here listen. Generally, enago date of arrival. Arrival is considered where? In India. And departure also is considered in India only. But only in this continuous discharge certificate, joining is considered outside India and signing off also considered outside India. So joining to signing off when they considered outside India. So it is an exception to this rule. Generally, arrival departure when they in India. But in this case alone, arrival departure is outside India. Outside India. Okay. So this also quickly let us see. Be quick with this question. Mr. Anand is an Indian citizen, member of a crew of a Singapore bound Indian ship engaged in carriage of passengers in international traffic from Chennai port. From the following details, determine the residential status of Mr. Anand for assessment year 26-27, assuming that his stay in India in the last 4 previous years is 400 days. So you calculate. Very, very simple question. So now what you have to do? Listen, first you have to see whether the conditions are satisfied for the special provision. What are the conditions? That the person should be Indian citizen, crew member of a foreign bound Indian ship on an eligible voyage. Now all the conditions are satisfied. That is why the date from joining in CDC to the date to up to signing off from CDC will be considered as outside India. Outside India. So what is considered outside India? 6th June, 9th December. So in June, you have to consider how many days? 30 minus 5, 25 days. Okay. Any doubt? 6th? 6th June also you have to consider, no? So 6th to 30th, how many days? 25 days. That's what I told. From date of joining to date of signing off. Generally, arrival departure is considered in India, but in this case, arrival departure is considered outside India. Outside India. So in June, 30 minus 5, 25 days you have to take. Then July, August, September, October, November, December, how many days? 9 days. 9 days. So 6 also you have to consider outside India. 9 also you have to consider outside India. 6 also outside India, 9 also outside India. In the case number 2, generally arrival departure is in India, but only in this special case, arrival departure is outside India. So 25 plus how much? What is the total? 187. So 187 is outside India. So what is the number of days stayed in India? 365 minus 187, which is 178. 178 is the number of days of stay in India. Days stay in India. So since now first basic condition not satisfied, second basic condition, should you see or not see tunnel kulla poiruvangla? Answer is yes, they will go inside tunnel because they are an Indian citizen, crew member of a ship which is leaving India. That is why they will go inside tunnel. You need not see the second condition also. That is why this person will be called as non-resident. Non-resident. So you need not this 400 is there. No, this is only to confuse you. Confuse you. Okay, got it? Shall we move on? Now let us see quickly residential status of HUF, AOP, BOI, firm, local authority, AJP. So all the other persons other than individual and company. You have to see control and management of affairs karna. Listen. If control and management of affairs is fully outside India, then non-resident. If konja kuda, even if some amount of control and management is in India, they will be called resident. Okay. For whom? HUF, AOP, BOI, partnership firm, local authority, AJP. For all the assessees other than individual and company, what you have to see? Control and management. Control and management fully outside India, non-resident. Even if it is partly in India, they will be called as resident. In HUF, like individual, you also have to find out whether the HUF is a ordinarily resident or not ordinarily resident. So how to find out? First you find out whether HUF is a resident or not. Aduvandi how to find out? See control and management of affairs. If control and management of affairs is fully outside India, HUF is a non-resident. If it is partly in India, HUF is a resident. After determining whether HUF is a resident or non-resident, if at all HUF is a resident, then you see what is Karta. Okay. If Karta is ROR, HUF is ROR. If Karta is not ROR, HUF will be RNOR. Okay. If Karta is NR, what will happen? If Karta is NR, then HUF will be RNOR. RNOR. Why? Because HUF can be non-resident only if it is wholly outside India. Partly India means non-resident scope illa. It is either ROR or RNOR only. Fine. Then for company residential status is covered in CA final level. But in CA Inter, if you know this much, it is enough. A company is considered as non-resident means other than resident. Non-resident means other than resident company. Then who is resident? Indian company, always resident. Indian company, always resident. Other than Indian company, resident if poem is in India. Poem. Poem means place of effective management. Place of effective management is a place where key management and commercial decisions of the entity are in substance made. Key management decisions are being made. That is only place of effective management. For this, many conditions are there. All these conditions are there in final syllabus, not there in Indian syllabus. If you know this much, it is enough. So now residential status, we know how to calculate. Now let us come to scope of total income. Scope of total income. This is for scope of total income only we are finding residential status. Okay. So in scope of total income, there are different types of income. First, income received in India, income deemed to be received in India, income accruing or arising in India, and income deemed to accrue or arise in India. These first four categories are called as Indian income. Indian income plus or Indian income actually. Indian income. Okay. Then see the fifth one. Income accrued and received outside India. Means income accrue also outside India, receive also outside India. So it is what? Foreign income. But from a business controlled or profession set up in India. Business controlled or profession set up in India. It means it is foreign income, but it is not foreign source. It is other than foreign source. So that is why first 5 categories are called other than foreign source. Indian income is always called other than foreign source. Other than that, if it is a foreign income, but it is from a business controlled or profession set up in India, that is also called as other than foreign source. It is a foreign income, but other than foreign source. So these 5 categories are only other than foreign source. This only you have to calculate within 15 lakhs or above 15 lakhs for residential status. Okay. Then see the next one, accrued and received outside India. Business controller profession setup also outside India. So it means what? It is a foreign income only, foreign source. Foreign income, foreign source, fully foreign. And then last one also, any other foreign income. This is also foreign income, foreign source. Now if you see resident, ordinarily resident, all the types of income are taxable. For non-resident, only Indian income is taxable. For resident but not ordinarily resident, other than foreign source is taxable. Other than foreign source is taxable. For resident, ordinarily resident, global income is taxable. Non-resident, Indian income is taxable. And for resident but not ordinarily resident, other than foreign source is taxable. Fine. So global income is taxable 1 to 7. RNOR, Indian income plus income accrued and received outside India from a business controlled or profession setup in India is taxable, also called as other than foreign source. And the non-resident Indian income is taxable 1 to 4 in table above. Then there is remission. What is remission? Remission means to remit or to send. To send. So I have earned some money. This money I am just sending to someone else. Let's say I am sending to my father or I am sending to my mother. Does it mean my mother have earned the money? Answer is no. It is just sending the money. Hence, remission is not taxable. Whether it is ROR, RNOR or NR, remission is just sending the money. It is not earning the money. That is why it is not taxable. Then some small points. First, accrual or receipt is only taxable. Transmission of the same amounts to remittance. So first time when you are getting, that is only considered as taxable. Later on it is considered as remittance when you are sending to someone else. Receipt by other person on behalf of the assessee shall also be considered as receipt of assessee. So for example, if I have to receive the salary, instead of me someone else is receiving the salary on my behalf, then also it will be considered as my income only, because I have only earned the income. They have just received it on my behalf. Okay. Then foreign income shall not be considered as income accrued in India just because it is included in balance sheet in India. So let's say there is an Indian company, subsidiary of a foreign company, they have to prepare a consolidated balance sheet. In that consolidated balance sheet, foreign company entries are also there. Now, since foreign company entries are there in the balance sheet, does it mean that the foreign income will become Indian income? Answer is no. Just because it is written in balance sheet does not mean it will become Indian income. Then this is a specific point, sometimes tested in multiple choice question. So you should know salary received by non-resident seafarer for service rendered outside India on a foreign going ship received in NRE account shall not be taxable. Received in NRE account. So if all these conditions are satisfied, then the income is not taxable. 2-3 times you read this. Maybe if it comes in MCQs, it will stick. Okay. Then now, what is income received in India? First time the income is being received in India. That is only income received. Then deemed to be received in India. Deemed to be received in India includes 4 points. Number 1, contribution to RPF greater than 12%, interest in RPF greater than 9.5%, employer contribution in pension scheme, employer contribution and interest transferred from UPF to RPF. All these points are linked with salary chapter. When I take salary tomorrow, you will be able to identify. Okay. Then accruing or arising in India. What is accruing or arising? Accrue means right to receive the income. Accrue means right to receive the income. Due means right to enforce payment of the same. So whenever the payment accrues in India, it is accruing or arising in India. Let me give you a small example. Okay, let's say there is a person, Mr. A, who is working under an employer. He is working during the Feb month. So Feb month he is working. Then his salary becomes due on 3rd March. 3rd March. Finally, he receives the salary on 15th March. So what did I say? February he is working in the organization. Then 3rd March his salary becomes due and his employer is actually giving him the salary on 15th March. On 15th March. Now in this case, the February month where he is earning the salary is only called accrual. Accrual. Okay. So this, while accrual is going on, where he is doing the service, you have to see. If he is doing the service in India, it means it is accruing or arising in India. In case of salary, it is accruing. In case of business, the profits arise. So it is called arising, accruing or arising in India. It is called accrual. Then 3rd March, it becomes due. Due means what, sir? Due means now he is having the right to receive the salary. Right to receive the salary. In the February month, when he is working in the organization, on February 20th, can he go to the employer and demand the salary? Answer is no. He has to wait till March 3rd when his salary becomes due. Then only he can demand it from the employer as per his contract. So this, on March 3rd only he is getting the right to receive salary. It is called due. And on the date in which he is receiving the salary is called receipt. Receipt. Fine. So this is only difference between accrual, due and receipt. For scope of total income, accrual has to be considered. Either already it is mentioned above. Once again it is mentioned. You can ignore. Okay. So now accruing and arising is also over. Now let us come to deemed to accrue or arise in India. Deemed to accrue or arise in India. Shall I continue? Shall I complete it or tomorrow should I take? Huh? Exciting, na? Complete? I'll complete. Fine. Question maybe we can work out tomorrow. Theoretical part I'll complete now. You just review it once and tomorrow we will complete the question also. Morning. So income deemed to accrue or arise in India is given in section number 9. Section number 9. Listen here. So there are cases where a confusion might arise whether the income is accruing or arising in India or not. To remove the confusion only, the government is telling that in these cases, income is always deemed to accrue or arise in India. It means what? Whatever is stated in this table will always be considered as Indian income. If it is Indian income, then what will happen? If it is Indian income, resident also has to pay the tax, non-resident also has to pay the tax, because Indian income means everybody has to pay the tax. So what are these cases? Let us see. First, section 9 subsection 1 clause 1, income through or from business connection in India. This business connection used to be a detailed part in your syllabus. Now it is fairly cut down and it is not there in your syllabus. Only exception to business connection is there in your syllabus. Business connection means what? Business connection means, let's say there is a foreign company. That foreign company is bringing an agent into India, indirectly doing business in India. That is only called business connection. Now, what are not considered as business connection? Let us see. So there are 5 cases where it will not be considered as business connection. Not business connection means what will happen? It means it will not be deemed to accrue or arise in India. Not deemed to accrue or arise in India means not Indian income. Okay. So what are the 5 cases? Number 1, business operations which are not carried out in India. For example, Apple company is there in USA. It is sending some agent into India, and through that agent, Apple company is doing business in India. Correct? Whatever agent is operating in India, it will be considered as business connection. But if that agent is doing any activity outside India, is it business connection? Answer is no, because the operations are outside India. So if operations are outside India, it is not business connection. Second one, purchase of goods in India for the purpose of export. Let's say Apple is appointing an agent in India. That agent is buying iPhone in India, but he is not selling to Indian. He is buying iPhone in India and he is exporting to Sri Lanka. In such case also, since he is not doing business in India, he is exporting to Sri Lanka, no, that is why it is not considered as business connection. Okay, purchase of goods in India for the purpose of export. Then collection of news and views in India for the purpose of transmission outside India. Let's say a foreign news agency, BBC News, is coming into India, collecting the news, and it is transmitting outside India. In such case, government has given an exception. We will consider it not business connection. So it will not be considered Indian income. Then shooting of films, cinematographic films in India, if such non-resident is a individual who is not citizen of India, or a firm which does not have any citizen partner or citizen shareholder who is citizen of India, or company which does not have any citizen shareholder who is resident in India. Listen, so if a non-resident person is coming and shooting films in India, it will not be considered as business connection. But there is one more condition, that non-resident should also not be citizen of India. If non-resident is a partnership firm, there should not be any citizen partner. If non-resident is a company, they should not have any citizen shareholder. Okay. In such case, that non-resident, when they are coming and shooting films in India, no, it will not be considered as business connection in India. Then last one, activity confined to display of rough diamond in special notified zone by foreign mining company. So in India, the government will have some special notified zones. In that notified zone, if there is a display of diamonds, that is exhibition of diamonds by foreign mining companies, it will not be considered as business connection. For example, in Surat, there is the biggest diamond bores. So all the foreign mining companies will come to Surat and display their rough diamonds. In such case, it will not be considered as business connection. So these are the 5 points where there is no business connection. Then next, business connection is over. Now let's come to the next point, income through or from any property in India. So in India, there is any property, for example, land or building. From that land or building, you are receiving any rent. It is called income accrue or arising, deemed to accrue or arise in India. Then any asset or source of income in India. If there is any asset, for example, plant and machinery is in India, using that plant and machinery, some production is running. So whatever production income you are getting from the production, it is Indian income, deemed to accrue or arise in India. Transfer of assets situated in India. In India, you are having any land or building, plant, machinery, furniture, whatever it may be, asset is there in India, that if you are transferring to some other person and earning capital gain, that is deemed to accrue or arise in India. Then next one, salary earned in India and pension earned for the services rendered in India. So if you are earning salary in India, deemed to accrue or arise in India. Let's say some foreign company person is there. They are coming to India for 1 year for some project work. In such case, in this 1 year they are working in India, no. Whatever salary they are earning from India will be taxable in India. Fine. Then let's say for 30 years I worked in India. After 30 years I retired and went to USA. Retirement, I went to USA. In USA I am receiving pension from my old employer. Is this pension also deemed to accrue or arise in India? Answer is yes. Because for my salary which is done in India only, I am receiving pension. That is why this pension is also deemed to accrue or arise in India. Then rest or vacation immediately before or after rendering service is also included. That foreign company employee who is coming into India for 1 year, sometimes what they do, they will tell that we have come here only for 2 months for project. Balance 10 months is vacation in India. Balance 10 months is vacation in India. So like that they will try to avoid that tax. Hence, it is told in the provision itself, immediately before service or immediately after service, if there is a vacation, that vacation period is also included. If you are receiving the salary for this period, it is also included in deemed to accrue or arise. Then section 913, salary by the government to Indian citizen outside India. So Indian government is paying salary to Indian citizen outside India. It is taxable, deemed to accrue or arise in India. However, section 10 clause 7, there is an exemption which states that if such person is receiving any perquisite or allowance, it is tax free. So if Indian government is paying salary, it is taxable. But if Indian government is giving any perquisite or allowance, okay, for example, driver, free car, food, whatever it is, that is fully tax free. Okay. Then section 914, dividend distributed by Indian company outside India. So an Indian company is distributing dividend, it is always deemed to accrue or arise in India. Last one first pakla. Section 918, money paid without consideration by an Indian resident to a non-corporate non-resident or a foreign company or RNOR if the aggregate sum exceeds 50,000 and taxable under 56.210. In income from other sources, we are going to learn a section called 56.210, where we are going to study that if the gift received is more than 50,000 rupees, it is going to be fully taxable. Similarly, if a non-resident or a non-corporate company, non-corporate non-resident means what? All the non-residents other than companies. Okay, and company case la vandu foreign company. So if a non-corporate non-resident or foreign company or RNOR is receiving gift of more than 50,000 rupees from whom? From Indian resident, then it will be deemed to accrue or arise in India. Now let's talk about interest, royalty, fee for technical services. First, quickly let us see what is the meaning of royalty and fee for technical services. Meaning of royalty. We are not going much deep into the definition, not that important from examination point of view, but just have a reading so that if at all it is coming in question, you are able to identify that it is royalty. Okay, consideration. What is royalty? Consideration including lump sum consideration, but excluding any consideration which would be income under capital gain. So what first line what they are telling, if income is covered under capital gain, then see capital gain. It will not be called royalty. Only if it is not capital gain, it can be called a royalty. So for what and all reasons? Number 1, transfer of all or any rights in respect to a patent, invention, model, design, secret formula, process or trademark or similar property. So these are all intangible assets. So if you are transferring any rights in the intangible asset and getting the money, it will be called as royalty. Second, imparting of any information concerning the working of or the use of patent, invention, model, design, secret formula, process, trademark, similar property. Regarding all these intangible assets, first you are transferring the rights. Second, you are giving the information relating to the usage of these intangible assets. Okay, that is also royalty. And third one, you are allowing the use of the same patent, invention, model, design, secret formula, process, trademark, similar property. You are allowing other people to use and you are getting the money. That is also royalty. So all the three are royalty. Then fourth one, imparting any information concerning technical, industrial, commercial, or scientific knowledge, experience, or skill. So for giving out this skill, if you are getting money, that is royalty. Then use or right to use any industrial, commercial, or scientific equipment. You are having equipment, you are allowing other person to use, getting the money, that is also royalty. Then transfer of all or any rights, including license in respect of any copyright, literary, artistic, or scientific work, including films or videotapes, for use in connection with TV, or tapes for use in connection with radio broadcasting, or for use in connection with radio broadcasting. So you are having any rights in what? Copyright, literary, artistic, or scientific work. For this, if you are having any right, copyright, you are transferring it and you are getting the money. That is also royalty. So I have written this book. This book is published by Tarun Sprineri, given to you. On all these books, I earn a royalty from the books. So that is royalty. Then with all these above, concerning all this above, if you are rendering any service, also it is called royalty. Then consideration for use or right to use of computer software is also royalty. Then the term process includes transmission by way of satellite, cable, optic fiber. So process does not mean that I should come physically and give you the process in the hard copy form. I can also send you via electronically, digitally. And lastly, consideration of sale, distribution, exhibition of films is also covered in royalty. So for sale, distribution, exhibition of films, movies, it is also covered in royalty. So this is the definition of royalty. Just read it 1 or 2 times, glance panna podum, that is enough. Then fee for technical service. What is fee for technical service? It is the consideration for managerial, technical, or consultancy service. Managerial means what? I am doing the managerial work. I am leading. I am taking the decisions on behalf of entity. That is managerial. Then technical. Technical means I am having some technical expertise. For example, some computer coding knowledge I am having. With that, I am helping my client with some technical work. Then consultancy service, I am giving them some advice. So all these three are covered under fee for technical services, including providing the services of technical and other personnel, but does not include salary. For example, if a person has hired me, let's say I am a computer engineer, the person has hired me to come there and to come to their place and develop a software. This is technical service. Now for this technical service, I might send my staff. Okay, so my staff also, they are making the payment. So this is called fee for technical personnel. It is also covered under fee for technical service only. But listen, if they themselves are hiring some staff and that staff is doing that computer work, is it fee for technical service? Answer is no. That is salary kana. Pureda. If they are giving me the money, I am giving my staff, that is fee for technical service. They themselves are employing means that is employee. That is not fee for technical service. And fee for technical service does not include construction, assembly, mining. Construction, assembly, mining here, it is not fee for technical service. So now we know what it is. Now let us see what happens if interest, royalty, fee for technical service is paid to a non-resident. So now what are we learning? Non-resident is earning interest. Interest means what? When loan is there, on that loan, they are earning the interest. Okay, on money borrowed. Interest, royalty, fee for technical service. Who is earning? Non-resident is earning. Now we will see that in the hands of non-resident, whether it is deemed to accrue or arise in India or not. That we are going to see. First, if the government is paying interest, royalty, fee for technical service to this non-resident, then all such sums are deemed to accrue or arise in India. Everything is deemed to accrue or arise in India. Then, if a resident is paying interest, royalty, fee for technical service to a non-resident, then all such sum except money borrowed, royalty, fee for technical service is used for business or profession outside India or earning any other income outside India is not deemed to accrue or arise in India. So if resident is giving non-resident, then in the hands of non-resident, generally it is taxable. But if that resident is using money borrowed, royalty or fee for technical service for doing business, profession or any other income outside India, okay, they are using it outside India. In such case, non-resident need not pay any tax. For the non-resident is not deemed to accrue or arise in India. You are getting my point? Okay, clear? Then Now non-resident is paying non-resident. Okay, Biden is paying Trump. Biden is paying Trump. So in one foreign country, one non-resident is paying another non-resident. Why should we be bothered? So generally, it is not deemed to accrue or arise in India. Generally, not deemed to accrue or arise in India. However, if at all money borrowed, royalty, or fee for technical service is used for business in India, then it will be deemed to accrue or arise in India. Okay. So one non-resident is taking. Shall I give example? Quick example. Trump, Biden. Okay. So Biden is taking loan or Biden is taking royalty. Sorry, paying royalty. He has taken copyright or taken technical service. Okay. And he is paying money to whom? Paying money to Biden. Now this loan, copyright or technical service, if he is using for business in India, then what will happen? In the hands of Biden, whatever amount is received will become deemed to accrue or arise in India. Purida? Trump is paying to Biden. Okay. But Trump is using it for business in India. In such case, in hands of Biden, it will become taxable. It will become taxable. Now, this is for business. What if Trump is not using it for business, but he is using it for other source? Instead of business, he is using for other source. Just a second. Is using for other source. Instead of business, if it is other source, then you know what will happen. Then he can pay interest, royalty, fee for technical service. Fee for technical service. Then you know what will happen. In the hands of Biden, royalty is deemed to accrue or arise in India. Fee for technical services deemed to accrue or arise in India, but interest is not deemed to accrue or arise in India. What did I tell? First example I told you that if Trump is taking loan, copyright or technical service and he is paying what? Interest, royalty, fee for technical service to Biden. So when Biden is receiving it and Trump is using for business in India, then everything is taxable in the hands of Biden. Okay, everything is taxable. But if Trump is not doing business, instead of business, he is earning some other source. Other source na enna irukkalam. For example, Trump is investing in Indian company. He has taken loan and he is investing in some Indian company and he is earning dividend. Dividend is not business income, no, it is other source income. That is why in such case, royalty and fee for technical service will be taxable in hands of Biden, but interest will not be taxable in hands of Biden. This is an exceptional case. That is why I have written money borrowed and I have striked it off. I have also given you an example. Example, if non-resident A borrows from non-resident B and invests in shares of Indian company, then interest payable by A to B will not be deemed to accrue or arise in India. Fine. And here, for interest, royalty and fee for technical service, there is no territorial nexus. There is no territorial nexus. It is deemed to accrue or arise in India, whether or not the non-resident has place of business in India or has business connection or has rendered service in India. So listen, for this Biden, I am telling no, it is deemed to accrue or arise in India. Is it necessary that Biden should be there in India? No, it is not at all necessary. He might be sitting in some corner of the world. Still, he has to pay the tax in India. Purida. Why he has to pay the tax? Because Trump has used loan, copyright or technical service in India. That is why Biden has to pay the tax. And there is no territorial nexus. It means it does not matter if Biden is having place in India or not. Okay. So it is clear. Question we will let us do tomorrow. We'll break now and tomorrow 7:30 let us start.